So how will the new Trump tariffs affect your income taxes and your wallet?
Instead of taxing our citizens to enrich foreign nations, we should be tariffing and taxing foreign nations to enrich our citizens.
President Trump has repeatedly stated that the new tariffs will generate additional tax revenue, which could allow for reductions in income taxes for American workers, families, and businesses. But a lot of people want to know the what, when, why, and how this will actually affect their wallets. So as a licensed CPA that has been updating you on every new progression in Trump's tax plan this year, I want to update you on where things currently stand and how the most recent tariff announcements may impact you. Okay, so let's talk about these Trump tariffs. These are basically taxes on US imports that are typically paid by the US-based business importing the good or product. And the Trump administration recently announced a series of tariffs, including a minimum 10% tariff on almost all US imports and several reciprocal tariffs to return even higher taxes on specific countries who they believe is, quote, taking advantage of the US, which means we may see price increases on a wide range of products we enjoy and need, and businesses that import those products will also have to absorb those costs one way or another, either by raising their prices for consumers or reducing their own profit margins, if that is even possible. So to no one's surprise, immediately after this announcement was made, people panicked. Stock markets decreased in values, and the VIX Fear Index increased to an all-time high in 2025, which tends to correlate with US recessions. And it's because people do not know what to expect right now. This could develop into an all-out trade war, which will continue to impact businesses and families, but this is just expected to be the short-term impact. The expected long-term impact of this is that foreign companies will now bring their businesses to the US to avoid these expensive tariffs. For example, manufacturers of goods heavily impacted by tariffs like electronics, automotive parts, or textiles might find it more economical to set up production facilities within the US rather than pay these high import costs. And if we have more businesses coming into the US, that also means we would have more jobs. And all the newly created income from these jobs and businesses would be subject to US taxes, like federal income tax, state income tax, payroll taxes, and so on. Not to mention the fact that there will be additional tax revenue collected from the tariffs to begin with, which is estimated to be at least $700 billion in tax revenue each year. So optimistically speaking, the long-term impact of these new tariffs is that it will result in more jobs, more businesses, and more importantly, more tax revenue for the government, because these would be tax-paying businesses, which will afford the government the ability to offer tax cuts to US taxpayers as a whole, in theory. But what exactly are those tax cuts and where exactly do they stand right now? Well, currently we are in an interesting situation because your taxes may actually increase if a tax bill is not passed very soon here. And that is because many tax provisions in the 2017 Tax Cuts and Jobs Act that reduce taxes for most taxpayers are set to expire at the end of 2025, like the increased standard deduction, the decreased individual tax rates, and a number of different business and investment related deductions like the QBI deduction, bonus depreciation, and more. So if Congress does not pass a tax bill before these provisions expire, then literally millions of people will pay higher taxes even if they earn the same amount of income. So to better understand the potential tax impact here, let's just look at a very simple example to illustrate. So let's say we have a married couple with $100,000 in income who is currently in the 22% marginal tax bracket. Well, in 2025, they will receive a $30,000 standard deduction, but that will be cut in half to about $16,000 without TCJA. So we just lost a $14,000 deduction roughly. But then let's say the income they earn also qualifies for the 20% QBI deduction, which would grant them an additional $20,000 deduction on $100,000 of their qualifying income. And to add to this 22% tax bracket is actually a reduced rate. After TCJA expires, it would increase back up to 25%. So if we take the $34,000 in deductions we would lose here and multiply it by a 25% tax rate for simplicity, this family would pay $8,500 in additional taxes just from the expiration of the Tax Cuts and Jobs Act. Now, a part of Trump's tax plan, he is promising to extend these tax provisions, which would mean we will be able to continue enjoying larger deductions and lower tax rates. And in addition to that, he is aiming to exclude certain sources of income from taxation altogether, like Social Security, overtime pay, and tip income, for example. Plus, his plan also includes increases to the SALT cap and itemized deduction, decreases to the corporate income tax rate, and promises to close certain tax loopholes that the ultra-wealthy currently benefit from. But as of right now, these provisions have not gone into effect yet, and are pending congressional approval in the form of an official bill. And the major challenge with passing a bill that cuts taxes is finding a way to pay for it. Because if the government cuts taxes, then that means they receive less money that they can use to operate. And if the government does not have enough money to operate, then it could shut down or close critical programs that people rely on. But here's the good news. Congress has already started taking steps to create room in their budget to afford the Trump tax cuts. In February, I informed you that the House of Representatives approved a budget which would allot up to $4.5 trillion for Trump tax cuts over the next 10 years. And this was a huge step because whenever someone promises tax cuts, the first question people have is, well, who is going to pay for it? So that additional spending helps clear that question up and opens up funds for this. Plus, the Trump administration is actively looking for ways to cut unnecessary spending with the goal of cutting over $1.5 trillion of spending over the next 10 years. So right now we have new tariffs, which will bring in $700 to $800 billion in new tax revenue, and another $4.5 trillion in additional spending that will be allocated to tax cuts over the next decade, while cutting over $1 trillion in government spending. These progressions increase the odds of a significant tax bill passing this year, and I will be the first person to update you once we have more information. So be sure to subscribe to stay in the loop, comment your thoughts below, and if you currently pay a lot of money in taxes and want a plan to reduce it immediately, just go to mycpacoach.com to apply to work with my team of CPAs today.